going to get to the stock market analysis. And we're going to take a look at the S&P 500. We'll look at the VIX. And we're also going to look at the market condition monitor. This is the approach we're going to take. Those of you that are interested in seeing the NASDAQ and the Russell, I'm not going to do that analysis today. But if you, of course, become a member, you can get all of those analysis. All of our premium member levels get some of those or all of those. Depending on what level you are. And our chart hub, which is level 2, is just mind-boggling how good that is for to be able to see all the analysis. This is the slide that's important for you to read before engaging in the analysis of things that we show. So always important to see that. So now we're going to get to the chart. So let's look here at the S&P 500. First thing we're going to look at here is that we're on the side-by-side, and we're looking at the dominant and minor cycles here on the weekly, and we're looking at the same thing on the daily. The weekly clearly has been rising in this strong upward phase. Momentum has been strong. You can see the reversal scout. The reversal scout said to you that the cycle bottom was in over here at 42.30, 42.40, something like that, and then rallied 550 points after that. So the reversal scout kept you on the long side based on this dominant cycle. This dominant cycle here is really the determining factor when you do all of the analysis. And how does that resolve itself? Well, it resolves itself in these positive cycles right over here. So now we have a timing issue because we were looking at a low to come somewhere right here in between these two timing lines right there, which said to us that was the highest probability. Year end, things tend to get a little funky because of taxes, because of reallocations. And I've said that a number of times these last couple of weeks. You don't always know what's going to happen, and there could be some shifting. Well, here, when I look over to the daily chart, we actually had some shifting, as you can see. So this grayed out ghosted cycle, as we call it, was what I was looking for, which called for this correction to continue here into somewhere around the middle of January. And of course, I get emails and comments that said, Slim, you said the market was going to go down until the middle of January. Well, the important thing is to understand is that this is money flows. This is these things shift around, and you can see how just reducing the cycle period minimally just moves it to where instead of being with this being the cycle length, this is now the cycle length. These are all shortened by the minimal amount. And then it really gives you a good handle. And when you look back, you can see it barely changes anything at all. So there was a tiny little energetic shift in here. And this is clearly what happens. As I said earlier in the show, Arvi looked at the different sectors and he saw the bottoms forming in those sectors in the short term. And that keyed me to look at the higher probability that this was occurring. And we saw this bottom form. What's really interesting is that in this corrective period, the slim ribbon stayed positive the whole time. You can see the slim ribbon often is a source of support, as you can see right in here. In this rally, it was a source of support. And it's often a resistance when it bounces back up. Sometimes it gets up a little through it and then comes back down. And look at the slim ribbon PO. This tells you when momentum is likely to resume to the upside. No lying here, because all of this was really telling you that it was turning up. And then when we got a sense that the different groups were turning up already, we knew that it was time to make this adjustment. What we're looking for in here is our upside target zone. This is the 78.6% fib extension and the 100% fib extension. And the 100% weekly extension is at the same place here. So 48.90 approximately is a reasonable upside projection in here. The middle darker arrowed cycle track, as you see there, we're kind of forming two different channels. And it's right now on the bottom of the channel is just getting back up to that level, is telling us that, you know, if it doesn't want to get that high, it installs, that's 48.45. So this is 48.90. This is 48.45 right there. Here is the all-time high at 48.18, which is still hasn't gotten back up to yet, getting up to as high as 48.02 today. So these are the important numbers. The all-time high 48.18, 48.45, a reasonable upside expectation, 48.90, a potential upside expectation. If this rolls over to the downside and takes out the cycle low right over here, that would be a breakdown. 46.8211 is that key number. Now there's a 78.6% in here. I don't have it yet because this is still moving up. I'll put it in there for our members next week, which would be a warning level. But this is an absolute problem level under 46.8211. That would say that this dominant cycle here had turned down and it would have a long time to correct. You can see that this points to middle of March when that next dominant cycle correction comes in and syncs up with the minor one. Same date, March 15th, middle of March. If I go back over here and I show you this cycle on the weekly where middle of March comes, that is essentially right here, timing-wise, middle of March. That says that there is another whole short-term cycle period in there to come. And this period of risk comes after the rally following that middle March low. So we're looking for late March through early May as this next yellow zone, this next period of risk. That means that all of this, in the beginning of the show, I talked about the compression, the upside momentum fighting the resistances here in high valuations for the stock market, and actually can see us chopping around up in this area right over here. And then sometime late March through potentially April and early May, a very large downside could occur. Even if it only hits the bottom of this upward channel, which is a pretty optimistic view, that would still take you down to 4,400, which would be maybe an 8%, 9% decline right there. So this is the risky period right over here, late March through potentially late April or early May, that next period of risk, which you see right over here and over here. In the meantime, we're looking for the stock market to continue moving to the upside, get up to those suggested levels, and then it will be a question about when we get into that March period. I want you to just take a look at this chart right over here. Our level 4 members get this, and Matt posts variations of this in his reports. And this is looking at daily momentum right over here. And we had some warnings right over here. Now the orange little dots went away because there's a component in here that is based on volatility. And sometimes when it's just barely getting to it, the dots come and go. You see in here when it made the bottom, the orange dots stayed. This was not enough of a move above the deviations or standard deviations to get it to hold in there, but we did get warnings of peaks, and then it did eventually come down 113 points or so on the downside, but you could see momentum here rock solid when you look at that in the S&P 500. So this is just another view of our indicators in here. And when this is green, as you can see right over here, it is a P3, and that tells you positive. It's very likely to be moving on the upside. When it's down here at P1 or into the P2s, you're likely going to be moving to the downside. So another great one of our ways that we look at markets for the momentum conditions. So now, before I wrap this up, I said I would look at VIX, and I think the VIX analysis is very important. And because we can get some good timing off of the VIX. Here are the VIX cycles right in here. And like I said, we're likely to continue rising here in the stock market, getting up to that S&P 48.45, 48.90 area. And you can see here that this cycle, and you can see the blue cycle right in here, that is telling you that there's probably another couple of weeks of rally right over here before this begins to move up and implied volatilities begin to jump. Right over here, you could see the implied volatilities made their low right at that timing, and they're already moving up. This looks like it's configuring in a positive way. In other words, it really looks like implied volatilities have seen their worst. And looking at this, it says that somewhere out here in February, there's likely to be another move in the stock market to the downside. But the real upside move in the implied volatilities don't come out over here until mid-March. You can see how that lines up with what I just showed you in the stock market, where there's a likely period of risk. And I labeled that right over here, stock market period of risk out in March, April. That's the time frame you got to look out for a big downside move. I'd say it's 8 to 15% downside move during that time period. Now, we're going to go to one more really important chart that nobody has ever published before, and that is looking at the monthly VIX. This is looking at the monthly VIX all the way back to 87. And what I have in here is showing you, and this is, I built on what I showed in the big picture analysis, the year-end show, that special report, showing you how these pops and implied volatilities come and how they relate to events or to market conditions. And you can see right where we are right here, and that is the likelihood that there is a very important trough in implied volatilities coming. So what happens when you get to when both of them are coming down to these lows? Well, you get the crash of 87, which occurred right over here. And in that first area right over here, implied volatilities went up to, well, 152. Well, we know that's not likely to happen. I mean, that's just crazy. By the way, yes, I traded the crash of 87. It was chaos. Here you could see the debt crisis in 1994, and where implied volatilities had just a modest pop up to about 29 early in this period right over here. Here you could see this period of the bear market of 2000 to 2002 and the waves of higher implied volatility, 35, 35 here up to 48 in this early period. Now, this is a couple of years. This is a couple of years right over here. This right over here, well, it kind of held down near the bottoms over there until the bear market of 2008 and 9, when implied volatilities got as high as 90. That first pop over there was up to about 37. So again, we are really in the same spots in each of those, where the bottoms or the troughs are coming right in here and right in here and right in here, each of those market events. This was long-term capital management right there. I remember that very clearly. Right here was the 2000, 2001, where that bottom came right there. Here, of course, is the bear market from 2008, where that came. This is the debt ceiling crisis, the U.S. debt downgrade in 2011. This is the Greek debt crisis. So this happened at the mid-cycle point right over here. Look at this. This is where the pandemic came in right there. And you can see that this is where the you had that move up to 84 at that point. So where are we now? We're making this bottom right over here in implied volatilities. There is an event out there in these next couple of years. I just showed you that March, April is likely to come down in the stock market. I don't even think that's the event. I think it's coming out there further than that. But we could get into a period where volatility jumps very, very significantly in there. You could see all of those periods where these higher volatility periods came, and we're getting into one of those right now. I wanted to share that with you because I thought how important that was to know that, especially if you're a longer term investor. You know, the Fed, they're talking about Fed cutting rates. They're talking about the, interest rates coming down, 7 rate cuts this year, everything getting better, inflation coming down to 1.8% year over year. Everything is just absolutely great, right? Well, these charts are telling you there's chaos out there, and it's just a moment in time when things look better. So I just wanted to show you that. And that has absolutely nothing to do with what's going to happen tomorrow, what's going to happen next week, because as I showed you, the stock market is still in a bullish condition. So don't look at that VIX analysis that I just gave you and say it's time to go short. It's time to listen to what the charts tell you and they will tell you when there's a high probability that we're going to get into a more chaotic period. Right now, it's stable, moving up, energies are up, and that's what we're looking at. And that is my analysis in the stock market.